All right, I think we may have everybody. So good afternoon, everyone. My name is Alex Lyons. I'm going to be presenting today. We're going to be talking a little bit about just proactive tax compliance. So I have a quick disclaimer here. Just keep in mind with Avalara, we never give tax advice. So take everything that we are discussing today as just sort of guidance, and we are always happy to have one-off conversations to answer questions that you may have about anything that we talk about today, but never take any of this as legal or tax advice. So just a little bit about myself. So my name is Alex Lyons. I am a senior sales executive here at Avalara. I have been here for a little over 7 years now, actually getting close to 8. I have been working with the Sage team here at Avalara the entire time, and I have been aligned with Oasis as a primary partner for my entire tenure here. So I have worked with a ton of Oasis clients over the years and helped them sort of both address compliance challenges they may be having, and then also helping them onboard to use our actual automation software. So I am really excited to talk to everyone today, and if anyone needs anything after today's call, please feel free to shoot me an email. I'll also share my contact information at the end, so never hesitate to reach out if you need anything. So the agenda for today, I just kind of want to quickly go over just an overview of the U.S. tax landscape. For some of you, this may be redundant. You may have heard some of this before, but just kind of recapping what some of the changes that have happened over the last few years, go over a few of the recent trends and changes. We're going to talk a little bit about what the risk is of getting the compliance aspect of things wrong. I can provide some sort of color to what I'm seeing with clients I work with right now in terms of audit exposure and things that are happening in terms of contact from the state. So we'll talk a little bit about that. I also want to talk about 3 common areas of audit focus that we're seeing right now, some other notable areas of risk and compliance, and then at the end, we'll kind of cover solutions for minimizing your risk. So if any of the stuff that we talk about today sort of brings up a question for, are we in compliance? I'm going to talk a little bit about the steps you can take to address that, and then obviously have some time for question and answers. And we don't have a ton of people on today, so if anyone does have a question during this, please feel free to pop your question in the chat. Falana at Oasis is going to be monitoring that, so she can stop me, and I'm happy to answer questions throughout as well, so don't hesitate. So the first thing I want to talk about is just sort of, do you as a business have an obligation to collect and remit sales tax? And so also an important part of this is the definition of nexus. So a company's nexus footprint is their obligation to collect and remit sales tax in another state. So the things that are going to trigger a company's obligation to collect and remit tax in a state or their nexus footprint are most commonly going to be economic presence or physical presence. If any of you have ever talked with Avalara in the past, you've probably heard a little bit about this, but physical presence is something that does go back quite a ways. So 10, 15 years in the past 10 to 15 years, physical presence laws with the states have been changing. So historically, a company's nexus footprint for physical presence would have been where their office was located. But over the last 10 to 15 years, those laws were changed to include really anything that puts an employee or product in another state on behalf of the business. And so common things I sort of see get missed around physical presence are trade show attendance. If you've got people who are traveling to visit clients out of state, whether it be just to have a meeting or installations, if you're doing software installations, if you're doing product installations, delivering any products on your own vehicles. The trade show thing is a very big thing that people commonly miss. So if you are going to another state to attend a trade show, that is something that can trigger physical presence. Those things have been in effect for a very long time at this point. So if any of those things are sort of things that are happening for your business and you're not registered in those outside states, it might be worth having a conversation about, where you stand right now. Economic activity is something that is newer. And when I say new, it's newer than physical. It's not really new anymore. So economic activity was introduced in 2018 via the South Dakota versus Wayfair ruling. So As of 2018, the states also have economic thresholds in place that can cause you to have triggered a nexus into another state. So if you are selling across state lines and you are exceeding what the states have deemed substantial economic presence, that is another way of creating nexus. And I do have a couple of slides in this to kind of show you what that presence looks like. Less common, but still something to take into account are affiliates and referrals. From an affiliate standpoint, something that gets missed is if you have like product demos or product displays in stores in other states, that's something that can kind of trigger a nexus, even if you're not physically going there. If you're advertising for yourself in another state, that's something that can be viewed as a nexus footprint. Those are less clear, the affiliate and referrals. So again, if it's something that you have a specific question about, it might be worth having an individual conversation. But these are just the things that are going to trigger your company's obligation to be registered in an outside state to collect and remit sales tax. In terms of those economic thresholds, the nexus thresholds are different for every state, like I mentioned. So most of the states have a threshold of $100,000 in sales or 200 transactions. And so what that means is if you're selling a piece of equipment that is $100,000, that can trigger a nexus footprint from an economic perspective. Or if you're selling 200 widgets that are only worth $200, that can also trigger a nexus in most states. That's not the case for every single state. There are nuances with some of the states around what they're including in those dollars and transactions, but for the most part, it is something to think about if you're exceeding either of those metrics in a certain state. A common misconception around the economic aspect of nexus is that it only impacts you if you're selling something that's taxable or direct to consumer. That is not true. So 39 of the states do actually look at gross sales. So meaning if you are selling for resale, if you're selling for tax exempt purposes, if you're selling to manufacturers, anything that's tax exempt can also count into those thresholds in the majority of the states. Also, 45 plus states do require marketplace facilitators to collect and remit tax on your behalf. So basically, if you're selling through Amazon or eBay, there are some aspects of that can also trigger nexus. So where do you have economic nexus? This is a map just sort of showing what those thresholds look like. A couple of noteworthy ones are Texas and California. Those are the highest thresholds. So both California and Texas look at $500,000 in gross sales as well as 100 transactions. So you have to have 100 transactions worth $500,000 in gross sales to trigger nexus in those states. But you can see the majority of them are falling into that $100,000 threshold, and a lot of them do have that 200 transaction amount tied to it as well. And then with exempt sales, this is just sort of showing, since most of the Sage clients I work with are manufacturers and distributors, most of them are not dealing with sales tax in the traditional sense that you think of sales tax, and most of my clients are dealing with managing exemption documents. And so even if you have a lot of exempt sales or the majority of your sales are tax exempt, this is certainly something that can impact you. So this is just sort of showing all of these orange states are the states that are including exempt sales. So those are the states that are just looking at your gross sales into the state. The blue states are the ones that do not include exempt sales, so you don't have to worry about those if you are, selling everything for resale, for example. The split, the purple states are a little bit more confusing. Those are the states that exempt services. So if you are selling services, those do not have to count into those thresholds. So it's definitely a little complicated. It is something that's kind of difficult to keep up with. Avalara does offer services to help evaluate this, which I'll talk a little bit more about as we proceed today. But any questions about this, again, it's always worth having a one-off conversation just to sort of talk through what your scenario is. Something that I see a lot right now is lots of businesses are changing how they sell, who they sell to, and whenever you make big changes like that, it is going to change your tax implications, most likely. One of the most common things I see right now are lots of businesses are starting e-commerce sites. So even my clients that are primarily wholesale are getting e-commerce sites set up so that their clients can purchase and order online. And so anytime you're adding a new channel of selling like that, it's worth having a conversation about what that's going to do to your sales tax obligations. And so you can see also, obviously, if you are hiring a remote employee, that's something that you always need to take into account. If you are opening a new office, if there is a acquisition happening that's going to bring in another company under your umbrella, anything that's a major change to the business and how your business operates, it's always worth having an additional conversation to kind of see how that's going to affect your tax obligations. So companies that are audited can owe unpaid tax plus penalties and interest. So this is something that is happening more and more often with the clients that I'm talking to each week. Lots of the states, now that we are so far post the Wayfair ruling that happened in 2018, are starting to contact companies that they feel may have triggered nexus in their state. They do that most of the time via a letter that they will send out. And there's certain states that are more notorious for this than others. But what's really important to note is if you do have a state that you were supposed to be registered in that you're not, there is a chance that you could have unresolved tax liability, or if you are not properly managing your exemption documents, that can also be a big area of risk and exposure. In terms of penalties, most of the states are going to charge a 10 to 50% penalty on top of whatever the tax or interest is due to that state. So it can get very expensive, and so it's always good to sort of just keep an eye on this and understand where you stand as a business. So something that Avalara can help you with is taking care of this unaddressed nexus. And I am helping clients through this process just as much now as I was back in 2018 when the economic presence laws were introduced. So it is not uncommon that the people that I talk to are still in a situation, even though it is so far past 2018, that they have not actually addressed any nexus changes that could have impacted them. So most commonly what we will do, and I have another slide to talk a little bit more about this, but the sales tax risk assessment. So we have a questionnaire that we can provide your business that will allow you to answer questions about your physical and economic activity in all of the different states so that we can help you determine where you may have a nexus footprint where you are not registered. It is an incredibly valuable service because it is going to tell you where you stand as a business and help you have an understanding of where your risk lies. Depending on what your risk looks like, Avalara does also have services to help you with addressing that. So if you need to register in any additional states, we can help you with that. We are very often helping businesses with voluntary disclosure services. So if you are in a situation where maybe you have some past liability that has not been resolved with the state, you are able to enter the state through an amnesty program that's called voluntary disclosure. So basically what that is a way to anonymously register with the state saying, hey, we know we haven't been in compliance, but we want to get in compliance. And so when you go through that program, the states will allow you to pay less than what is typically due to them. So they limit your look back period in terms of tax liability that may be owed. They also typically waive your penalties. And then another important factor in the Sage world is that a lot of the times they're not going to ask you for copies of your exemption documents. So if you haven't been doing a great job maybe of managing those for all of the states that you sell into, this is a way of kind of getting set up in the state without having to prove that the sales that you've been selling are tax exempt. So these are some of the services that we help with. It's certainly not limited to that. Sometimes people will also do back filing. So if you have a situation where maybe you've only had Nexus for the last 6 months, we can also just sort of help you file in arrears to get caught up. So there's lots of ways to address this, and we can help you with all of it. Most of the time, it does start with doing that risk assessment, though, just to kind of figure out where you stand and what you're going to need help with. A really important point. So compliance is not optional. It is the law. And I always say that doing the risk assessment is sort of giving you that peace of mind. It's telling you where you stand. So instead of sitting around and kind of being like, oh my gosh, there's this black cloud hanging over my head, we know we're not in compliance, but we don't really know what to do. Doing the risk assessment sort of rips the Band-Aid off, and that it's telling you exactly what it is that you may be missing, so that you can then make an educated decision on how to approach it. So the peace of mind that comes with doing the risk assessment, I think, is invaluable because it is going to tell you what you should be worrying about and maybe what you don't need to worry about. So this is a survey that we conducted last year, just asking clients, what do you typically find most challenging when it comes to sales tax? You can kind of see here, most of the people are most overwhelmed with keeping up with the changing tax laws. They are changing all the time. You've got states like Colorado and California who are just changing their tax rates, sometimes month to month. You've got exemption information changing. You've got states like Florida, Georgia, Alabama that are implementing changes to their resale certificate laws, for example, and making it where those documents expire every year. So there's lots of changes that happen, and it's a hard thing to keep up with when you have Nexus in more than, one or two states. Tracking and managing your Nexus footprint is something people struggle with. The tax calculations when you are registered in the states, managing exempt sales, 23% people find that most challenging. I would honestly, this is kind of a broad look at just our client base in general, but I would say in the Sage world, I would even venture to guess that percent is higher for managing exempt sales in terms of being the hardest part, because so many of my clients are dealing with primarily customers who are tax exempt. So that is a big challenge I see with my client base day to day. Remitting sales tax, and then the 10% is having complications with international tax requirements. I know that's not a huge deal in the Sage world, but these are just, just some common areas of pain that our clients are seeing. I want to focus on the exemption certificate aspect, just since that is what I am seeing most commonly in my world. So I want to talk about the cost of a missing exemption certificate. And this is something that really frequently gets overlooked when managing tax compliance. And so when you are selling for resale or you're selling to people who are tax exempt, most of the time your thought process is that you don't have any tax exposure. The reality is you really don't. However, if you don't have the proper exemption document on file for the customer that you're dealing with, then you could have risk, you could have exposure. So just to show kind of an example of what the cost looks like if you are missing an exemption document. So if your business is being audited and that auditor reviews a sample of your sales over the last month, or this is in this example, 36 months, the auditor may find a missing document or a sale that was worth $15,000, there's a missing document, and tax revenue at 8%, that's $1,200 that should have been paid that was not paid. What they will typically do is assume the amount of uncollected tax for each month during that audit period. So what then quickly happens is they're going to take that $1,200, multiply it by 36 months, and then all of a sudden you're being smacked with a $43,000 bill on top of penalties that state may charge, which, like I said, penalties in each state can range anywhere from 10 to 50%. So missing one document can then all of a sudden cost a lot to your business. Now, depending on the auditor you're dealing with, if they're having a good or bad day, sometimes they may allow you to go back and collect an exemption document from your client. They may allow you to get an affidavit for the customer to sign saying, hey, we did pay use tax on this transaction. So there are situations where you could potentially get out of that fee. But then there is a situation that you might be dealing with an auditor that isn't as nice, and they may not let you out of it. You never really kind of know what you're going to deal with when it comes to a state audit. So it is always better to make sure you have your exemption documents and that they are correct and valid and up to date so that you don't have to worry about this. So the way that people combat this in our world is by using our tool called ECM. The ECM tool is integrated with Sage 100 if you are on a current version of Sage 100. And what this allows you to do is when you are creating a new customer in your customer maintenance in Sage, you are actually able to request an exemption document from that customer directly from within Sage by clicking a button. What that process looks like from your customer's perspective is they will receive an email with a link that will prompt them to fill out the document that is required for the state that they're operating in and for the reason that they're tax exempt. So they'll be allowed to say, I'm a reseller, or I'm a manufacturer, whatever reason they're tax exempt, and then it's going to ask them to fill the document out that's required for the state. Our system is going to collect that document. We keep track of it. We keep track of the expiration date. We will auto request the renewed document whenever it is due. So basically, after you accept that initial document or request that initial document, our system will automatically manage those documents on a move forward basis. So it essentially eliminates the risk associated with mismanagement of these documents. It also does work with Sage in that when you are processing invoices, we are able to do a real-time check to see, does that customer have a valid exemption document on file, so that we can make that tax determination to say they do have a document on file, we are not going to charge them tax. So it kind of creates a checks and balance in the process to make sure that at the time of purchase, that customer does have a valid document on file, and that you're making the right decision and not charging them tax. So the three common areas of audit focus, the first thing is taxability determination. So a lot of auditors will look at whether tax should have been collected based on the product or service that you're selling. And so this is something a lot of people struggle with in the Sage world, because they might be dealing with contractors, and maybe different types of jobs are going to have varying taxability, or maybe you're selling equipment that based on how that piece of equipment is being used, it has varying taxability. This is a major problem, and the way to sort of combat that on our side is we do have a tool called Avalara Tax Research. This tool is going to allow you to look all of this up. So you can look up the product that you're selling, where you're selling it, and you're able to quickly see, is this product taxable, is this service taxable, and you will also see the tax legislation that is actually going to back up that decision, and you can quickly access that tax law. You can read through it. You can also share it with your customers or your colleagues to kind of prove why you're making the decision that you're making. This is ultimately going to help you when you're audited, because you will have made the right decision at the time of purchase. The second big area is sales tax rate accuracy. So there are over 13,000 taxing jurisdictions in the country. So 50 states, over 13,000 tax jurisdictions. So if you are selling in states like Louisiana, you've got all of the different parishes to deal with. If you're in California or Colorado, you could have someone who is literally your next door neighbor that is in a different taxing jurisdiction. So this is a very big piece of pain when you are dealing with multiple states, dealing with the actual rates for every single jurisdiction. And what this means in Sage is you actually have to have a tax schedule tied to every jurisdiction that you're selling into. So it's just not realistic to think that you can keep up with that manually if you are dealing with many states. You can see here just a little bit of the stats around the tax rules, requirements, and how often that they're changing. So tax holidays are something that I see come up pretty frequently. So you've got 98,000 tax holiday updates. So throughout the country, you've got holidays that are going to change tax rates. So there's a lot of different things to keep up with here, and it's just really unmanageable, like I said, when you're dealing with, more than one state. So the way to combat this is through Sage Sales Tax. This is our AvaTax engine. If you've ever talked with us, or if you've ever been to a Sage trade show, you may have seen it advertised as either Sage Sales Tax or AvaTax. They are one and the same. This is fully integrated with Sage 100. What we do through this tool is override the native tax functionality in Sage. This allows us to provide you with real-time tax decisions. So we will either calculate tax based off where your customer is located and get that jurisdiction exactly correct and apply the exact rate that goes along with that jurisdiction, or we're able to make the determination that that customer is tax exempt through that ECM connection. And then reconciling recorded versus reported. So when it comes time to actually file your returns, this is something that when you're going through audits, there's a lot of pain around making sure that what you've actually charged the customers is what's being remitted to the state. So this is something that's pretty hard. And then the way that we can combat that on our end is Avalara does have the ability to actually take all of the data from Sage on your final invoices, pull that directly into our system where we're able to automatically create sales tax liability reports for every state that you're in, and then we are going to use that data pulled directly from Sage to file and remit your returns to the state on your behalf. So as long as the Sage connection is there with our AvaTax engine, all of that would be done automatically, and so there's not a lot of room for error. So lastly, kind of talking about the sales tax risk assessment, most of the time this is the first step in this process. So if you have never had a conversation with Avalara, if you have never had a conversation with your CPA around what your tax implications may be, this is an outstanding place to start, and it is free. So there is no reason not to do it. If you have any question in your mind about, are we in compliance, this is an awesome place to start. This is something I can give you access to. So if you reach out to myself or if you reach out to your account manager at Oasis, we can get you access to this. But what it is a guided questionnaire that will allow you to answer questions for business activities that are happening in every state. We will cover anything that would trigger physical nexus, and we will cover anything that would trigger economic nexus, so that we can then generate a detailed report explaining to you where you have nexus and where you are not registered. And then through that process, we can also help you to evaluate if there might be any tax liability and kind of help put together a game plan for how to tackle that if there is a problem that needs to be resolved. This is a $4,500 service that's offered for free through our Sage partnership, so it's incredibly valuable. And I see so many clients start this project with this process. So again, if there's any question in your mind at all, please take advantage of this while it's free, because it is a great resource. And in terms of peace of mind, it will tell you exactly what you're missing, or tell you what it is that you're ignoring, which at least then you will know. And I am finishing right on time. So do we have any questions that I can answer today?
It looks like you had one question in the Q&A. Did you get the one from Callie?
Oh, I did not. Let me see.
Okay.
Once you obtain there we go. Once you obtain an exemption certificate from a customer, are these required to be updated annually or on a certain frequency? So the answer to that question is it depends. It depends on the reason that that customer is tax exempt, and it also depends on the state. So resale certificates are most commonly going to expire usually either annually or every 2 to 3 years. So Florida, for example, I know their resale certificates expire every single year. And since they implemented that change, a lot of states around them have started to kind of follow suit. So annual renewals of those resale certificates are very common, but it's also not required for every single state. It really depends on the state. There are some documents that are tax exempt forms that don't expire at all. It really just depends. And that is something our ECM tool keeps up with. So you don't have to. So whatever the reason that they're tax exempt when they fill out that document for us on our side, we will be able to track that expiration if there is one and auto request the renewed document whenever it is due. Anything else that I can answer today? While we're waiting to see if anyone pops anything else in, I just again want to please welcome you to reach out to me if any of this prompted a question in your mind. I typically have conversations around, Nexus questions 1 to 2 times a week with companies. I am always happy to talk about this with you. And if you would rather reach out to your Oasis account manager, they can connect you as well. And again, that risk assessment is free. So please take advantage if you have any questions in your mind. And we can get you access either through myself or through Oasis. So just let us know. And if there's no other questions, I don't think that there are right now, I guess we can wrap up. I appreciate everyone's time today so much for joining. Please let us know if you have any questions.
Thanks, Alex.
Have a great afternoon, everyone. Thank you.